So let's be real for a second, okay? You've probably heard that it's basically impossible to buy a house right now in 2025. You've seen the headlines, you've felt that pit in your stomach, right? The market is chaotic, prices are still sky high, and it just feels like you're priced out forever, okay? But what if I told you that most of us are asking the wrong question? We're obsessing over house prices and those stubbornly high mortgage rates, but the real secret is knowing if you can afford a home that isn't hiding in all that market chaos, okay? It's hiding in your own finances, okay? So in this video, we're going to cut through that noise. We're going to ignore the headlines and give you the personal finance metrics that will actually tell you if you can afford a home. Now, these are numbers that will give you clarity, a sense of control, and a real answer to the question, can you afford a home in 2025? So, my name is JasonGelios. I'm a Michigan Realtor, for those of you who don't know. And for years, I've been helping people make smart, empowered decisions with their money in terms of buying or selling real estate. And today, we're going to do just that for you, okay? Put together some really good stuff here. Now, first off, the wrong numbers, right? So the first mistake almost every hopeful home buyer makes is looking at the wrong number first. It usually lands in your inbox with a big flashy subject line like, congratulations, you've been pre-approved for $500,000, okay? And it feels like you just won the lottery. But your chest puffs out a little bit, right? You're excited. You immediately jump on Zillow and start looking at houses in that price range. $500,000, wow, great. But this pre-approval amount is one of the most misleading numbers in the entire home buying process. Let me be clear here. So the pre-approval amount is not what you can afford. It's what the bank is willing to risk on you, okay? It's what they're willing to risk on you. So it's the absolute ceiling of what they think they can lend you and still get their money back. Lenders have risk, okay? They don't know about your dream of starting a family, your goal to travel, or the fact that your car is rattling its way to the graveyard and it could cost you some more money. Right? They don't care if the payment makes you house poor and forces you to eat ramen noodles for the next 30 years, which I like ramen noodles, by the way, okay? But still, you get my point. Their job is to manage risk for their business, not to plan a comfortable life for you, potential home buyer. The other trap is that simplistic online affordability. Calculator. So you know the one, right? The one you plug in your income, it spits out a huge, exciting number. These calculators are often just tools to get your contact info to lenders and real estate agents so that they can sell you. They almost never account for the full picture, right? Student loans, credit card debt, or the fact that property taxes will absolutely go up. They give you a headline number designed to get you excited, chest puffing up, but not to get you prepared, okay? They don't get you prepared. They really don't. Relying on these numbers in a calculator online is like letting a car salesman decide your entire family's budget. Of course, he's going to push you toward the bigger, more expensive model vehicle, okay? The key is to take back control by building your budget from the ground up, based on your life and your numbers, not the bank's numbers, okay? Now, the right numbers. So let's talk about the numbers that actually matter, okay? These aren't secrets, but they get overlooked in the frenzy of house hunting. We're going to build your financial fortress brick by brick using 4 key metrics, okay? Metric 1 is the 28-36 rule, which is a lifesaver, okay? This is one of the oldest and most reliable rules in personal finance for a reason. It's a guideline designed to help keep you financially healthy, okay? Not just to get you a mortgage. So the rule has 2 parts. The front end part says no more than 28% of your gross monthly income, that's your income before taxes, should go toward your total housing payment. This isn't just a mortgage, it's the whole package. Principal, interest, property taxes, and homeowners insurance, which is referred to as PITI, P-I-T-I, okay? It also includes any homeowners association fees. And then the back end part says that no more than 36% of your gross monthly income before taxes should go to all your debts combined, okay? Your monthly debts combined. That's your new potential housing payment, plus car loans, student loans, and minimum credit card payments. So sure, lenders might be willing to stretch this a little bit. I've seen this when I was a lender. Sometimes they stretch it a little bit. Some loans allow you to go up to 43%. I don't recommend it, but they do. Sometimes it's even up to 50%. You never know. Okay. So that 36% is the guardrail, though, that protects your financial life. It makes sure that you still have money left over to save, invest, and actually live. You don't want to be house poor, okay? Metric 2 is your debt to income ratio, or what's referred to as DTI with lenders. This is the back end of that 28-36 rule I mentioned. And it deserves its own spotlight because it's the number lenders care about most. Your debt to income, or DTI, ratio is the clearest snapshot of your current financial obligations. Okay? To figure it out, just add up all your monthly debt payments, monthly debt, okay, and divide them by your gross monthly income. Very simple formula, okay? Today's first-time home buyers often carry a lot of debt before even thinking about a mortgage. Matter of fact, in 2025, the average student loan payment can be around $500 a month. And car payments are often just as high. Cars are more and more pricey, and so therefore the payments go up, okay? No real, rocket science there, okay? But this debt directly shrinks your purchasing power. The more monthly debt you have, the less purchasing power you have. Let's say your gross monthly income is $7,000. Now, according to the 36% rule, your total monthly debt, mortgage included, shouldn't top $2,520 a month. If you already have a $500 car payment and a $400 student loan payment, that's $900 that you have to subtract right off the top. Your maximum affordable housing payment just dropped from over $2,500 to just over $1,600. That's a huge difference in how much house you can afford, especially in certain areas, okay? Your DTI, debt versus income, debt to income, is your financial footprint. You have to know where you stand before you can decide where you're going. Metric 3 is the power of your down payment. The down payment is your skin in the game, right? It reduces the risk to the lender, okay? And you get a better option, typically. It's the one lever you have the most control over that can dramatically change your monthly payment and the total cost of your loan. Now, if you've probably heard the myth that you need 20% down. That's not true, actually. Many loans allow you to put as little as $0 down, actually. While hitting that 20% mark helps you avoid what's called private mortgage insurance, is definitely not a requirement. In fact, the median down payment for first-time buyers is closer to 8 or 9%. Different loans have different minimums, okay? Conventional loans, your standard 15-year mortgage, 30-year mortgage, they can go as low as 3% down, and FHA loans, or government-backed loans, require at least 3.5%. And if you qualify, VA and USDA loans can require 0% down. But a larger down payment does three powerful things, okay? First, it lowers your monthly mortgage payment since you're borrowing less. Second, it can help you snag a better interest rate because lenders see you as less of a risk. I mentioned that earlier. And third, you need to hit that 20% on a conventional loan, and you get to skip private mortgage insurance, which is an extra monthly fee that protects the lender, not you, by the way, okay? And it can cost a pretty penny. I've seen it in some cases where it was an extra $100 or $200 a month, okay? Saving for a down payment is tough, though. I get it, right? Especially when everything is so expensive, but every extra dollar you can put down pays you back for decades, saves you tons on interest. Metric 4, the hidden cost of owning a home, right? So this is the number that everyone forgets. Your mortgage payment is just the cover charge. You have to account for all the other costs of owning a home. Property taxes and homeowners insurance are obviously the big ones, and they can add hundreds, sometimes thousands of dollars to your monthly housing bill. And they can and will go up over time. As values go up, so do property taxes. But it doesn't stop there. Is there a homeowners association fee? A homeowners association, that's another fee. What about maintenance? A good rule of thumb is to actually budget at least 1% of your home's value every year for maintenance and repairs. 1%. Okay? For example, a $400,000 house, that's about $4,000 a year you should budget for maintenance costs and upkeep, okay? Or over $330 a month. The water heater will break, the roof will need replacing. These aren't emergencies, they're predictable future costs, okay? You know that these things are gonna happen eventually, okay? If your budget is so tight that one big repair would send you into a financial spiral, you can't afford that house. You don't wanna be house poor, like I mentioned earlier. You have to budget for the total cost of ownership, not just the mortgage. So let's put it all together, okay? Theory is great, but let's make it real. Let's run some numbers for a hypothetical couple earning a combined gross income of $8,000 a month. So you got 28% for housing, which is 8,000 times 0.28, which gives them a maximum recommended housing payment of about $2,240 a month, okay? Then you go on the back end, like I mentioned earlier, 36% for total debt, which you take $8,000, which is their gross income, and you times it by 0.36, which gives them a maximum total debt load of about $2,880 a month. Now, we look at their existing debts. Let's say they have 2 car payments totaling $700 and student loan payments of $500. That's $1,200 in non-housing debt, non-housing related debt. Now, we see how that debt eats into their housing budget and brings their purchasing power down. Their max total debt is $2,880. Subtract their $1,200 in debt, and that leaves $1,680 for their maximum monthly housing payment. So you see what happened? Even though the 28% rule said that they could maybe afford a $2,240 payment, their debts knocked down that number to $1,680. More debts you have, less purchasing power you have. This is a real number they should use. This is their true affordability. And then from here, they can work backwards with a mortgage calculator, plugging in interest rates, which are hovering right now in 2025, mid to high 6% range, okay? And local property tax rates to see what home price that monthly payment actually gets them. This simple exercise gives them a realistic, conservative budget based on their actual life, not some fantasy number from a bank. And if your number is lower than you hoped, that's not a failure. Don't feel bad. It's just a diagnosis, right? It tells you where you're at. It gives you a target. It might mean you need to pay down debt first, save up for a bigger down payment, or maybe just adjust your expectations on the size or location of your first home. So can you actually afford a house in 2025? The answer isn't in the headlines. It's not in panicked articles about market forecasts and that there's a bubble or what the Fed might do next. The real answer is in your numbers. It's in your income. It's in your debts. So your savings and your budget, okay? So the housing market will always be a chaotic storm you can't control. It's going to happen, right? It goes up and goes down. You can't control interest rates. You can't control housing inventory, but you can control your own financial situation. By focusing on this 28-36 rule I just shared with you, understanding your DTI ratio, right, debt to income, strategically planning your down payment, and budgeting for the total cost of ownership, you go from being a victim of the market to being the architect of your own financial future. So stop asking, can I afford a house? And start asking, what steps do I need to take to put myself in a strong financial position to buy a house? That's where your true power is, okay? That's how you win no matter what the market is doing. And that is how you'll know with total certainty when the time is right for you. Share your thoughts in the comments. Tell me what you think. I hope you click on my other videos. I have tons of information on my channel. Otherwise, I appreciate you watching and make it a great day.